Hi everyone, my name is Simon Mishevich from Optimize Accountants, and we need to talk about buy-to-let mortgages whenever you're looking to buy your next investment. And what better person to do it? No other than Simon Hodgson.
Yeah, as Simon said, specialist mortgage broker. I've been investing and helping investors for over 20 years. And my skill set is really creative funding and financing and helping you recycle your cash to go on to the next deal, really.
And we've been working together for such a long time. It's great to see so many of your clients that you've been helping, but let's just talk us through the range of products that you do offer out.
Oh yeah, good point. Yeah, so it ranges right from the typical vanilla buy-to-let mortgage, typically in limited company, but can do personal names. But as we know, or we're going to find out, interest rates kind of dictate that you can do a limited company with virtually no penalty these days. Then on to more complex buy-to-lets, larger HMOs, blocks of flats, refurbishment loans, development loans, commercial buildings, shops with flats above. Anything that requires a broker that needs a bit of nous rather than your standard estate agent broker that doesn't really understand anything other than a house to live in.
And when it comes to investing, we do need to think about interest rates. There's this whole debate. We was having discussion before this went live. Where will interest rates go? There's a lot of debate about where the US is going, where the UK will go. It could be anything between 4.5% and 7%, surely.
Well, okay. Well, that's a great point. And that's the point of this slide. So effectively what we're going to look at here, or we are looking at, is the SONIA swap rates. So effectively, this is the sterling overnight interbank lending. And this is roughly how banks price lending in between each other with a bit of profit margin involved. And it's typically what we've been known as a barometer rather than a thermometer. So it's not telling us what it is right now. It's telling us what the forward-looking markets are suggesting rates will do. Now, you can see the consistency of this through April to now. We've had Bank of England base rate hikes within that period. And lenders they've already really priced in where things are. So I can't say for sure. And at the moment, markets are predicting that we probably have seen the top of the rate rises, certainly in the UK and possibly over in the States with the Fed. At the very most, we might see another 0.25%, but that's quite slim looking at the moment. So I think we've got stability within the market, stability within rates, albeit at a higher level than we'd like.
Oh, a great update. Thank you for that. And obviously, as you say, there small increases, but nothing too significant, I don't think.
Nothing too significant. So just really to give a brief outline for everybody out there of the kind of products that are out there. If it's in personal name, they tend to start at 4.55 at the moment. And if you look right next to that, we've got limited company at 4.69. There's a small difference in arrangement fee. So it's slightly more expensive arrangement fee with a limited company. But other than that, there's very little penalty to buying a limited company these days. Service accommodation for 5.39. That's the best rate in the marketplace. I get some exclusive rates with lenders. I've got strategic partnerships with a number of lenders. So if they've got exclusive products that they want to push out with select brokers, that's what comes my way. And refurb lending. So refurb lending, that's from 0.75 a month. You can borrow up to 75% of the value of the purchase price and 100% of the works. If you are buying below market value, you can borrow 100% virtually of the purchase price and 100% of the works. There's some really great, fantastic deposit minimizing products out there for that. And HMOs, again, at that 4.69. As I said, that's a semi-exclusive, that is.
Some of those, a couple of things that I'm picking up from this is, and again, we spoke about this offline, 4.55% in your personal name, 4.69% in a limited company. Years gone by, that would have been 1.25, 1.5% more.
And more, yeah. And I suppose in percentage terms, if we were looking just over a year ago, you could get a buy-to-let in personal names for possibly 1.69. If you were doing it in a limited company, that same product would have been high twos, early threes. But in terms of as a percentage of 1.69, it's not far off double. It's about 70 to 80% more, whereas now it's single digit different.
Yeah, crazy. I mean, if people think about, should I buy in a limited company versus personal name? Trust me, there are so many advantages of buying in a limited company now, more than personal names. And I think that is now the new default. For anyone watching, should I buy my own name or a limited company? There are so many benefits to buying a limited company. That should be your default, by the way.
Yeah, indeed.
So you don't almost need a tax planning session with anyone now. It should be just a norm straight into that. But yeah, incredible about service accommodation as well. That's really low.
And then I think what we're going to do now, we're going to look at this, you know, for those watching now, this does look like a fairly unassuming property that you couldn't do anything with, that looks particularly tired. And it was. It no longer is. So this is a picture of it before work started. Yeah, I had to get a bit creative with this, find a way of making, you know, the numbers stack so the client could get all the money out. And as we go on to the next slide, we can kind of look at how the numbers shaped up to buy it. So bought as a shell. Literally, you went in, there were no facilities inside, no kitchen, no bathroom, no nothing. It all had to be done. Grade 2 listed, just on the front of elevation though. So internally, it was okay to get planning permission to turn into 2 flats. And typically what the architect had managed to do is squeeze a 3-bed flat on the ground floor and a 2-bed flat on the upstairs. Now, 3-bed flats typically aren't that popular and don't sell particularly well. And that looked like it was going to be a stumbling block. However, as we go on to the next slide, the value was 2 flats, came in at 325, which is only marginally more than the client was going to spend on the whole deal. So what we had to do is really work out a way of valuing that property differently, and then finding a valuer to kind of get on side with that methodology, and then also then convince a lender that we were going to value it in a way that was conducive to our thought process. So in that area, a 5-bed HMO valued at 425,000. They tend to all value it around that level. The client occupied the house on an inclusive bill basis as a 5-bed HMO. Now, effectively, there are 2 kitchens, so the facilities are actually slightly better because you've got less people sharing each kitchen, but it was still being used as 2 flats. So that then enabled us to push back at a valuer that we'd managed to get locally, talk about valuing it close to a 5-bed HMO. He agreed that he would come in slightly lower, and we were like, do you know what, 400 works for us, because 75% is a remortgage on the back end of 400, gives us a 300k new loan, and that pays off all the costs that went in. So this ended up being an infinite ROI, return on investment, a net cash flow after costs of 21,000 per annum. Don't need many of those to give up the day.
No, sorry. I mean, if you was doing this on your own, for instance, not using a mortgage specialist like your good self, could you even get to that thing of saying, well, can you value it on 2 different styles of property?
It would be valued at 325 all day long. So what happens, you would go to your average broker. Your average broker would kind of go, right, that's what we call a multi-unit freehold block of flats. There's 2 flats in the block. Place it with your average lender. The average lender will then send out the average valuer. He'll just go, right, it's 2 flats in this area, 2 flats. The max I can get to is 325. They might not even have valued at 325. They might have even come in lower, to be fair. And that's what would normally have happened. So then the deal wouldn't stack. Literally, you'd have had virtually all your money stuck in the deal, and you might as well have just gone and bought 2 flats for 300,000 and got a 75% mortgage straight off. You shouldn't. There was no point even doing the refurb. So it was really, really key to be able to add this value in for the client at the beginning before they bought it, to make sure that everything was going to stack, and then be there to help them get it off the lending and then onto a mortgage. Yeah.
So there you go, folks. If you do need a mortgage, and you need to be quite sophisticated to make sure you get all of your money back out, then you should not be using anyone else other than Simon Hodgson from Funded.